we need to be vigilant about new supply shocks that may undo the progress we have made so far. Headline inflation has remained high and has seen considerable volatility, moving in a range of 4.3% to 7.4% during the current financial year. Recurring food price shocks could interrupt the ongoing disinflation process, with risks that it could lead to de-anchoring of inflation expectations and generalization of the price pressures. Adding to these are the renewed flashpoints on the geopolitical front, including supply chain disruptions. Importantly, the CPI inflation target of 4% is yet to be reached. Monetary policy in the midst of these lingering uncertainties has to remain vigilant to ensure that we successfully navigate the last mile of disinflation. Now, the last mile of disinflation is always the most challenging, and that has to be kept in mind. Stable and low inflation at 4% will provide the necessary bedrock for sustainable economic growth. This point is very important because if we are interested in the long-term growth of our economy, then we need a regime of low and stable inflation. That is why we remain focused on bringing the inflation, to align the inflation to the target on a durable basis. I would now like to focus on the liquidity and financial market conditions, about which there is a lot of interest in the financial markets and also elsewhere. After remaining in surplus during April-August 2023, system-level liquidity turned into deficit from September after a gap of 4.5 years. Adjusted for government cash balances, potential liquidity in the banking system is still in surplus, and that may surprise you. But adjusting for government cash balance, potential liquidity in the system is still in surplus. During December-January, the Reserve Bank proactively injected liquidity through both the main and the fine-tuning repo operations to ease liquidity tightness in the system. With government spending picking up and augmenting system-level liquidity, I must mention that in the recent, particularly in the second fortnight of January, government expenditure was sustained. But I think there has been a significant pickup from the second fortnight of January, and also we are witnessing the same in February. And so with government spending picking up and augmenting system level liquidity, the Reserve Bank undertook 6 fine-tuning variable rate reverse repo auctions, that is VRRR auctions, during February 2 to February 7, 2024 to absorb surplus liquidity.